Welcome back to QHSE Talks, the space where we connect safety theory, professional practice, and CSP level thinking into one clear picture. Let me ask you something, and don't answer it too quickly. When a worker is injured on the job today, what do you expect to happen next? You probably imagine a process. A report is filed, medical care is provided, wages are partially replaced, a case manager gets involved, maybe a return to work plan is discussed. All of that feels normal, almost automatic. But here's the thing, that expectation is not human nature. It's not common sense, and it's definitely not how work injuries were handled for most of industrial history. What we now call workers' compensation is a designed system, a negotiated system, one that exists because the alternative nearly collapsed under its own weight. And for safety professionals, especially those preparing for the CSP, that distinction matters. Because Chapter 23 isn't just about benefits or claim forms. It's about risk transfer. It's about financial exposure, and it's about how injury outcomes ripple outward into insurance premiums, organizational budgets, and leadership decisions. In other words, this chapter lives right where risk management and program management intersect. And if you've ever wondered why executives care more about EMR than injury rates, or why a single lost time injury can follow a company for years, or why safety professionals are expected to understand insurance language even though we're not insurers, the answers start here. But to really understand why workers' compensation looks the way it does today, why it's no fault, why benefits are fixed, and why lawsuits are mostly off the table, we have to strip away the modern assumptions and go backward. Because workers' compensation didn't emerge because employers suddenly became safety-focused. It didn't emerge because government suddenly discovered compassion. It emerged because the system before it was unsustainable. Before workers' compensation, getting injured at work didn't trigger a claim. It triggered a legal battle. A battle where the injured worker carried the full burden of proof. A battle where time, money, and power were stacked against them. And this matters for modern safety practice because the entire workers' compensation system is built as a trade-off. Workers gave up the right to sue in most cases. Employers gave up the ability to deny responsibility. And in exchange, society created a structured, predictable way to manage occupational injury risk, financially, legally, and medically. That trade-off is the foundation of everything we're about to discuss, from disability classifications to claim management to EMR to return to work programs. So before we talk about premiums and multipliers, before we talk about documentation and cost control, and before we talk about why safety professionals play such a central role in this system, we need to understand the chaos that came first. Because without that context, workers' compensation just looks like paperwork. With that context, it becomes what it really is, one of the most important risk management systems in modern safety practice. And that's why we need to start where the system didn't exist at all.
We should start right at the beginning, or rather, the history before the beginning.
Right.
Because to understand why the system looks the complex way it does today, you have to understand the absolute chaos that it replaced.
The pre-modern landscape. And the source material, it paints a pretty grim picture here. We are talking about the Industrial Revolution, late 19th century, big machines, dangerous factories, basically no regulations.
It was a completely different world. Before workers' compensation laws existed in the United States, if you were injured on the job, you were essentially in the Wild West of the legal system. We were operating under what is called common law.
Which meant what, practically speaking?
Right.
For the guy on the factory floor.
Practically, it meant there was no automatic safety net. None. Zero. If you lost an arm in a textile factory accident in 1890, the company didn't just write you a check.
They didn't pay your hospital bills.
Nope. To get any compensation at all, you, the injured worker, who is now out of a job, probably disabled, you had to sue your employer.
And we know how well lawsuits go when you're a penniless, injured individual going up against a wealthy corporation with a team of lawyers.
It was David versus Goliath. But David had no sling. He had no rock. The burden of proof was entirely on the worker.
You had to prove they were negligent.
You had to prove the employer was negligent. And that was an incredibly high bar to clear because the employers had 3 specific legal defenses at their disposal.
The unholy trinity.
In legal history, yeah, that's what they're often called, because they were so effective at just crushing worker lawsuits.
I was reading through these in the Yates text, and honestly, they sound almost cruel by modern standards. It's like a system designed from the ground up to ensure no one ever gets paid.
That was pretty much the effect.
Let's break them down. The first one is assumption of risk.
Right. And it's exactly what it sounds like. The legal argument was simply, you knew this was a dangerous job when you took it.
Seriously, that's
the argument. By simply accepting the employment and walking onto the factory floor or, down into the coal mine, the law assumed you were waiving your right to complain about the hazards you found there.
So if I take a job at a steel mill and I get burned by molten metal because a ladle tips over, the owner can just say,
well, it's a steel mill. It's hot. It's dangerous. You knew that. Tough luck.
Wow.
Essentially, yes. The argument was that the wage you were paid included a risk premium. You accepted the risk as part of the transaction. It completely ignores the fact that people often have no choice but to take dangerous work to feed their families.
It assumes a level of bargaining power that the worker just didn't have.
Exactly. But legally, it was a shield, an ironclad defense.
It's a logic that says if you don't like the danger, you should have starved. Okay, so that's defense number 1. The second one is even stickier. Contributory negligence.
This one is it's brutal. Under the old common law system, if the employer could prove that the employee contributed to their own injury in any way, even 1%, if you were 1% at fault, the employer was off the hook completely.
Wait, really? So if the machine was totally unsafe, unguarded, basically a death trap, but I slipped a little bit, or maybe I wasn't paying attention for 1 second.
You get 0.
0.
0. It wasn't about who was more at fault. It wasn't comparative negligence like we have in civil courts today, where, if you're 10% at fault, your payout is reduced by 10%. No.
This was all or nothing.
All or nothing. If you contributed to the negligence at all, you could not recover damages. It demanded near perfection from the worker in an environment that was often inherently and deliberately unsafe.
That feels incredibly stacked against the little guy. It's demanding robot-like precision from humans working 12-hour shifts.
It is. And then there's the third one, which, to me, this one feels the most manipulative of all.
The fellow servant rule.
The fellow servant rule. Yeah. This creates a fascinating and completely toxic dynamic. It stated that if your injury was caused by the negligence of a coworker,
someone on your own team.
Right. If they messed up and you got hurt, the employer wasn't liable.
So let's play this out. I'm working on a scaffold. I'm doing everything right. But Bob, who works for the same company, is working above me, and he drops a hammer on my head.
Under this rule, you can't sue the company.
You can't.
The company's lawyer would stand up in court and say, we didn't drop the hammer. Bob did. We aren't responsible for Bob's clumsiness. Go sue Bob.
But Bob is broke. He's working the same low-wage job I am. He can't pay my medical bills for a fractured skull.
Exactly. And that's why it was so effective for employers. It shifted the blame horizontally between workers rather than vertically up to the management or the owners of the capital.
It pitted worker against worker.
Yes. And it insulated the company from the actions of its own workforce. A brilliant legal maneuver, if you think about it.
So you have these 3 defenses: assumption of risk, contributory negligence, and the fellow servant rule. The unholy trinity.
And the result, as Chapter 23 describes, was a system where litigation was difficult, payouts were rare, and tensions were incredibly high. But here's the twist. It wasn't a perfect paradise for employers either.
Why not? If they won almost all the cases, surely they were happy.
Because of the uncertainty. You have to remember, as industrialization ramped up, the number of injuries just skyrocketed.
It was a bloodbath.
It really was.
Yeah.
You had a growing class of maimed workers with no means of support, which led to social unrest. And occasionally, just occasionally, a jury would feel so sympathetic to a worker who lost both legs that they would ignore the law and award a massive verdict.
So the employers were living in fear of that one nuclear verdict.
The one that could bankrupt them. So they had almost total protection, but with this tiny, terrifying chance of complete annihilation, it was unstable for everybody.
Which leads us to the solution, the shift to what we have now. The text calls it the no-fault system.
The grand bargain.
This is the core concept you have to understand to get any of this.
It is. Society, led by some very pragmatic politicians and business leaders, decided to scrap the entire lawsuit model for workplace injuries. Just throw it out.
And instead, we instituted a system where liability isn't the question anymore.
For the most part, no. It doesn't matter whose fault it is.
So that's the trade.
That is the trade. The employee gets a fixed monetary award for their injury medical bills paid, a portion of lost wages, without having to put out the employer was negligent.
You don't have to sue.
You don't have to sue. You don't have to hire a lawyer. You don't have to overcome those 3 defenses we just talked about. The benefits are defined by law.
Okay, that's the win for the worker. Certainty and speed. They don't have to starve while waiting 3 years for a trial. What's the win for the employer? Why did they agree to this?
Immunity.
From lawsuits.
In exchange for paying these guaranteed but limited benefits, the employer is generally protected from being sued by the employee. You can't take your boss to court for millions of dollars in pain and suffering for a typical workplace accident.
The workers' comp payout is your exclusive remedy.
That's the legal term for it. It effectively ends the litigation war before it could even begin.
The goal was to avoid the delays and massive costs of the court system.
Right. And to do it while ensuring that injured workers and their dependents, in the case of a death, don't fall into poverty. It stabilized the economy for everyone.
Now, here is where it gets a little complicated for anyone listening who works for a big national company. The source material makes a specific point that there is no single U.S. workers' comp law.
That is a very, very common misconception. People think it's a federal program like Social Security or Medicare. It is not.
It's all state-run.
Workers' compensation is entirely state-specific. Each state has its own laws, its own system.
So the rules in California are different from Texas, which are different from New York.
Drastically different, sometimes night and day. Different benefit levels, different filing deadlines, different administrative procedures, different rules for what's even covered.
And as Yates notes in Chapter 23, this creates a complex web for multi-state employers.
Oh, it's a nightmare for them. If you are a safety manager for a company with branches in 20 states, you aren't dealing with one system. You're dealing with 20 different legal frameworks. You have to be an expert in all of them.
Is there any consistency at all, like on who has to have it?
There are some general rules. The text mentions that most states require employers to maintain insurance if they have a certain number of employees.
And the magic number mentioned in the text is 5, right?
Generally, yes. The source cites that most states require employers with 5 or more employees to maintain insurance, or, and this is for big companies, prove financial stability for self-insurance.
But again, most is the key word.
Always the key word. Some states might require it for 1 employee. Some might exempt, say, agricultural workers or domestic staff. You have to check the statutes in your specific jurisdiction. There's no substitute for that.
Okay, so we've established the system. It's no fault. It's state-run, and it's mandatory for most businesses. Now, I want to pivot to the person often stuck in the middle of all this, the safety professional.
And this is a critical distinction the author, Yates, makes in this chapter. There's this pervasive assumption in many companies that safety prevents the accident, and then if an accident happens,
They wash their hands of it.
right, they hand it off to HR. Our job is done. Here's the paperwork.
I've definitely seen that dynamic. Safety is about prevention. Workers' comp is about cleanup. HR deals with the money and the doctors and the insurance company.
And Chapter 23 argues that is a dangerous and frankly an incorrect way to view it. The text explicitly lists the safety professional's responsibilities, and they are heavily involved in the post-accident process.
So if you just abdicate this role to HR,
You are missing a huge piece of the puzzle. You're losing valuable data, and you're failing in your duty to the employee.
it's not just about guarding machines and doing training.
Not at all. Let's look at the responsibilities listed right there in the text. First, obviously, there's the first report of injury.
That's the official notification to the state and the insurer that something happened, the trigger for the whole process.
Correct. And accuracy there is absolutely vital. But then it goes deeper. The safety professional, the book says, acts as the liaison.
The bridge.
They are the bridge between the insurance carrier and the injured employee.
That seems like a really delicate role. You're representing the company, which has financial interests, but you're also dealing with a hurt colleague, a human being.
It requires high emotional intelligence. It's a tightrope.
Yeah.
But think about the third responsibility mentioned, investigation.
Of course.
The claim itself acts as a trigger. Every single workers' comp claim should kick off an accident investigation.
Connecting it back to root cause analysis, which is the bread and butter of any good safety program.
Exactly. If you just sign the check and don't investigate, you're just paying for the same accident to happen again next week or next month. The claim is data. It tells you where your system failed.
And if HR is handling it in a silo,
That data might never make it back to the safety team to actually fix the hazard. You're just processing claims, not preventing them.
and then there's case management. This was interesting to me. The idea that the safety pro oversees the whole process
All the way through.
until the employee returns to work without restrictions.
That is the ultimate goal.
Yeah.
The text emphasizes this over and over. It's not just about paying the bill, it's about the return to work. That's the finish line.
So the safety pro should be monitoring the progress, finding light duty options.
Keeping the employee connected to the workplace so they don't feel abandoned. It's a huge part of recovery.
There was a line in the text that really stood out to me. It wasn't just about the legal or financial requirement. It said ensuring employees receive appropriate care and compensation should be at the forefront of the safety professional's role.
Yes, the moral obligation.
It's easy to get cynical about insurance and claims, but at its core, this is about taking care of people who got hurt building your product or providing your service.
And that moral obligation aligns perfectly with the financial one. It's not a conflict. A worker who feels cared for and respected returns to work faster,
And they sue less often.
and they sue less often.
Yeah.
A worker who feels abandoned or disrespected drags out the claim and looks for a lawyer. So the safety pro is really the quarterback of this entire relationship.
So when a claim comes in, how does the system decide what it's worth? Or rather, how does it categorize the injury itself? The text breaks this down into a matrix of injury, 4 specific categories of disability.
And this classification is crucial because it determines the entire payout calculation. The duration and the severity of the injury dictate which bucket the claim falls into.
Let's run through them because this helps explain where all the money goes. The first one is temporary total.
Okay, so this is the most common type of claim by far. Temporary total means the worker cannot work right now. They are totally disabled for the moment, but, and this is the key, they are expected to make a full recovery.
So I break my leg on a construction site. I can't walk, so I can't work today, but in 6 or 8 weeks, the cast comes off, I do some PT, and I'll be back.
Exactly. You get paid a percentage of your wages while you are recovering. That's the total part. And then the payments stop when you return to work. That's the temporary part.
Makes sense. Okay, then you have temporary partial.
This is what most people would call light duty or modified duty.
Right.
The worker can do some work, but not their full pre-injury job. Maybe they're recovering from a back strain so they can't lift heavy boxes, but they can do inventory with a scanner or some desk work.
And usually if that light duty job pays less than their normal job, workers' comp makes up some or all of the difference.
Correct. It pays a benefit based on the wage loss. It incentivizes the return to work. It's better for the worker's mental and physical health to be engaged and earning something than just sitting at home.
Okay. Now we move to the more serious categories. Permanent partial.
This one sounds a little contradictory, right? How can you be permanent but partial?
Yeah, that's what I was thinking.
It means you have a lasting impairment, something that will never heal completely, but you can still work in some capacity. The classic example used in the text is the loss of a body part, like a finger.
Like losing the tip of your finger in a press, the finger isn't growing back.
Right, that loss is permanent. But the worker isn't totally disabled from all work for the rest of their life. They can still have a career, they just have a permanent impairment.
So how does the system compensate for that?
In these cases, the system usually has a schedule of benefits.
A schedule, like a menu.
Essentially, yeah. The state law will literally say, a thumb is worth this many weeks of pay, an index finger is worth this many, an eye is worth that many weeks, a foot is worth X amount.
That's always grim to think about, putting a specific price tag on a body part.
It is morbid, but it provides certainty. It prevents every lost finger from becoming a massive, multi-year lawsuit about how much a finger is subjectively worth. The law sets the value, and that's the payout.
Okay. And finally, the worst case scenario, permanent total.
The worker is unable to work ever again in any capacity.
This is a catastrophic injury.
Catastrophic. Loss of both eyes, a double amputation, a severe traumatic brain injury. This claim effectively becomes a pension for the rest of their life.
And obviously those are the most expensive claims for the system.
By an order of magnitude.
And the most devastating for the human being involved.
Right. And understanding these categories helps the safety professional forecast costs and manage risk. A temporary total claim is a cash flow issue. A permanent total claim is a massive liability that impacts the company's insurance rates for years and years.
Speaking of impacts on the company, Here is where it gets really interesting. This is where the rubber meets the road. We need to talk about the money.
The math of safety.
Because most people think insurance is just a bill you pay. You know, my car insurance is $100 a month, and that's that. But for companies, workers' comp is not a flat fee.
Not even close. It is highly variable, and it is directly mathematically tied to safety performance. This is where the safety professional becomes a profit center or a loss leader.
We have to talk about the EMR, the experience modification rate.
The mod rate. If you're in safety, this is the holy grail metric for the financial side of what you do.
The text gives a long explanation of this, so let's break it down as simply as we can. What actually is it?
Okay, at its simplest, it is a multiplier. That's all it is. It is a specific number used by the insurance industry to adjust your premium based on your specific history of claims.
Okay, so everyone in an industry starts at a baseline.
Yes, the industry average is always a 1.0. So let's say you're a bakery. The insurance actuaries look at all the data for all the bakeries in your state, and they figure out the average expected losses per dollar of payroll. That average represents a 1.0 EMR.
So if my bakery is exactly as safe as the average bakery, I have the standard number of burns and slips and strains, I pay the standard rate.
Correct. Let's use some easy numbers. If your manual premium before the EMR is calculated to be $100,000 and your EMR is 1.0, you pay $100,000. 1 times 100,000.
Simple enough. But what if I run a really tight ship? No accidents, great training, clean floors, nobody gets hurt for years.
Then your actual losses are lower than the expected losses for a bakery of your size. And because you're better than average, your EMR goes down. It drops below 1.0. Let's say it goes to a 0.8.
So now I take that same $100,000 premium.
And you multiply by 0.8. You now pay $80,000. You just save the company $20,000 purely by being safe. That is a credit rating. It's a discount.
That's pure profit that drops to the bottom line. But the flip side must be terrifying.
The flip side is the debit rating. If you are riskier than average, lots of claims, severe injuries, people getting hurt all the time, your EMR goes up. Say it goes to a 1.2.
So now I'm paying
$120,000 for the exact same insurance coverage that your safe competitor down the street is paying $80,000 for.
That's a $40,000 swing. That's a huge competitive disadvantage. You have to charge more for your bread just to cover your insurance.
It's massive. And it's not just about the insurance bill, as high as it is. The source text highlights the business case.
Yeah.
In many industries, especially construction and contracting, clients won't even let you bid on a project if your EMR is above 1.0.
Really? So you're not just paying more, you're being locked out of making money in the first place.
Exactly. A high EMR is a scarlet letter. It tells the world we are unsafe.
Yeah.
And big clients, general contractors, they don't want that liability on their site. So when a safety professional is asking for budget for new machine guards for more training time, they can point directly to the EMR.
It's not a soft cost.
It's not a nice to have. They can say, if we spend $10,000 here, we can lower our EMR from 1.2 to 1.1, which will save us $20,000 on premiums and allow us to bid on the new hospital project. It's the hard metric that justifies the safety budget.
It effectively monetizes safety culture.
It absolutely does. It makes safety a line item that the CFO understands. And there's a nuance here that the text implies, but is worth explicitly stating. The EMR formula is not simple. It's complex, but it usually punishes frequency of claims more than the severity of one claim.
Wait, explain that. Isn't a big $1 million accident worse than 10 small $1,000 ones?
In terms of raw dollars paid out, yes. But in terms of the EMR calculation, having 10 small claims, lots of little cuts and strains and sprains, often hurts your score more than one big freak accident.
Why is that? That seems backwards.
Because frequency predicts the future better than severity. One big catastrophic accident might just be bad luck, a lightning strike. But 10 small accidents, that means you have a systemic failure in your safety culture.
It's a pattern.
It's a pattern. It means you aren't managing risk. So the math is designed to force you to sweat the small stuff, because the small stuff shows that your entire system is broken.
That is fascinating. Now, even though we said earlier that this is a no-fault system, the text points out some fascinating legal nuances where fault sort of sneaks back in the side door.
Yes.
Or at least where the employer can get out of paying.
Absolutely. It's not a blank check for every situation. The system has checks and balances built in.
Let's talk about subrogation. This is a word I hear thrown around in legal circles, but I think for regular people, it's just confusing jargon.
It's a complex term, but the concept is actually pretty simple once you see an example. It's all about preventing double dipping and, more importantly, making sure the responsible party actually pays in the end.
Walk us through an example.
Okay. Imagine a delivery driver for your company is stopped at a red light. He's on a clock, driving the company van. He's doing everything right.
Okay.
Suddenly, a drunk driver in a personal vehicle slams into the back of the delivery truck, injuring your employee.
Okay. Since my employee's on the clock, that's a workers' comp claim, right? His back is hurt.
Correct. Your company's workers' comp insurance pays for his medical bills and his lost wages. That happens immediately because the system is designed to care for the worker first. No questions asked. But was the accident your company's fault?
No, not at all. It was the drunk driver.
Exactly. So, under the principle of subrogation, your insurance company has the right to step into the shoes of your injured worker and sue the drunk driver, or more likely, the drunk driver's auto insurance, to get their money back.
Ah, so they pay the claim up front to my worker, but then they go after the person who actually caused the mess to recoup the cost.
That is subrogation. And it's vital because if they successfully recover that money, it gets scrubbed from your loss run. It means that claim doesn't count against your EMR because ultimately it wasn't your fault.
That seems fair. But the text also mentions something I see in contracts all the time, a waiver of subrogation.
This is very, very common, especially in construction and the energy sector. Let's say you are a subcontractor working for a big general contractor, the GC. The GC will almost certainly put a clause in your contract demanding a waiver of subrogation.
What does that actually do?
It means that if the GC does something negligent that hurts your employee, your insurance company pays the claim, but they have to promise not to sue the GC to get the money back.
Wow. So they're just on the hook for the GC's mistake.
They're on the hook. You've waived their right to recover the money.
Why would an insurance company ever agree to that?
Because the GC has the leverage. They say, if you want this job, you give us the waiver. They want to shield themselves from lawsuits from every direction. But it usually comes with a cost. Your insurance carrier will likely charge you an extra fee to add that waiver endorsement to your policy.
Because they're taking on more risk.
They are giving up their primary right to recover costs, so you have to pay for that.
That is a crucial detail for anyone reviewing contracts. You might be signing away your insurer's rights without realizing it and costing yourself money.
Exactly. It's a risk transfer, and it's not free.
Now, what about the employee's behavior? We said contributory negligence is dead. But surely if an employee is acting completely recklessly, there's a line, right?
There is. Yeah. And the text lists these as modern employer defenses. Even in a no-fault system, there are certain behaviors that can disqualify you from receiving benefits.
Intoxication being the big one.
The biggest one. If you are drunk or high on the job, and that intoxication is the proximate cause of the accident, the employer generally doesn't have to pay. The system is designed to cover work accidents, not partying accidents that happen to occur at work.
That makes sense. What about willful misconduct? That sounds a little vague.
It's a higher bar to prove, but it exists. This isn't just, I forgot to wear my safety glasses today. This is, I intentionally tried to hurt myself to get benefits, or I blatantly, aggressively, and knowingly ignored a critical safety rule that was strictly enforced.
Like if there's a giant sign that says, "Do not enter death hazard," and a locked gate, and the employee breaks the lock to go in anyway.
That's the kind of thing we're talking about. Or self-inflicted injuries aimed at insurance fraud. Mm-hmm. The system covers accidents, not intentional, self-destructive acts.
The text also mentions gross negligence on the part of the employer. How is that different from regular, everyday negligence?
This is a really important distinction. Regular negligence is carelessness. I didn't mop up a spill in a timely manner. That is exactly what workers' comp is for. It's covered.
Okay.
Gross negligence is a conscious, voluntary disregard for the need to use reasonable care. It's recklessness. It's knowing something is extremely likely to hurt someone and doing it anyway.
It's a whole different level of culpability.
And interestingly, in some states, if an employer is found guilty of gross negligence, like sending a worker into a trench they knew was going to collapse without shoring, the exclusive remedy protection might be pierced.
Meaning the worker can sue them outside of the workers' comp system.
In some jurisdictions, yes. Or the workers' comp payout is doubled or tripled as a penalty. So the protection for employers isn't absolute either. It depends on them acting in good faith. If you are acting with gross negligence, the shield of the grand bargain might not protect you.
This brings us all the way back to the core message of Chapter 23. This whole system, the EMR, the disability ratings, the legal trade-offs, it's all a massive, complex machine. But what is the machine for? What's the point?
It's about restoration. That's the word.
The return to work.
That is the ultimate takeaway. Workers' comp isn't just about money. It's a system designed to restore the worker to their previous status, or as close as humanly possible. And for the safety professional, the job isn't done when the form is filed. The job is done when that person is back, safe, and productive.
And when you look at it that way, the EMR isn't just a math problem on an insurance worksheet.
No. And this is the provocative thought I want to leave our listeners with today. Think about your company's EMR. If it's above 1.0, if it's a 1.2 or 1.5, you are paying a premium.
A surcharge, a penalty.
But think about what that surcharge really is. You are literally paying a tax on your own inability to keep people safe.
Oof. That puts it in perspective.
It's a report card on your safety culture, written in dollars and cents. If you are paying that tax, you are funding the inefficiency of your own safety management system. You are paying for the privilege of being unsafe. The best tax break you can possibly get. Stop hurting your people.
And on that note, I think we're all going to look at our insurance renewals a little differently this year. It's not just a bill, it's a mirror.
Indeed. It reflects exactly how you treat your workforce.
That's a wrap for this deep dive into the grand bargain of workers' comp. Thanks for listening, and stay safe out there.